Assalamu alaikum friends. Welcome to SBR revision series for September 2021, and today we are going to cover the last IFRS that is left. We have covered all the other standards under for SBR. So this IFRS is for SMEs, okay? It is not for the normal entity, it is only for the SMEs. So let's start. The definition of small and medium-sized entities. IFRS. Why IFRS for SMEs is their omissions from SMA standard, some disallowed treatments, and some simplifications. Okay, because as it is the standard for SME, IFRS for SMEs, so definitely there will be more simplifications, more treatments which are disallowed, and also some omissions also compared to full IFRS standard. So, what is the definition of SME? What do you mean by SME? SME has to have this two feature. Okay, number one, no public accountability. It is not, they are not accountable to public. And second, they prepare financial statement, general purpose financial statements for external users. Okay, so why IFRS for SMA? There are two reasons for it. Number one, because this was issued for use by entities that have no public accountability, because for SMEs earlier there were no standard that they have to follow. There were no standard for them. That's the reason why they have built up this standard known as IFRS for SMEs. Earlier they were not there for those entities who didn't have any public accountability. That's why this is built. Then this reduces the burden also. Just go and check your IFRS, full IFRS. How many rules you have to follow? How many rules are there? Which might not be applicable for you, because this full IFRS this is applicable for big organizations, listed entities, not for the SME entities, because SME entities does not even have SME environment is not like listed environment. They don't have complex transactions. They are not that big organization. They are not dealing with the things which listed companies are dealing with. Okay, so due to that, it will be unfair for them to tell to comply with full IFRS standard. It's costly for them also. Okay, that's the reason IFRS for SMEs came up. So because of this, it reduces the burden for the SME. And in your exam, you can do a question which is Whiteberg in your revision kit, and mostly they will ask you the differences between full IFRS and IFRS for SME standards. Okay, so now let us start with the differences. There are some omissions from the SME standards, 4 omissions only that you need to know. Number one, earnings per share IAS 33 is not allowed under SME. SMEs are not supposed to comply with IAS 33, which is earnings per share, because they don't have public accountability. So earnings per share are for listed entities. Okay, so that's why it's omitted for SME. Assets held for sale, this is also omitted for SME, because SMEs are organizations which usually don't held asset for sale. It is usually done by big organization. That's the reason it's omitted. Operating segment, same segments also are operated by a very big organization, not for SMA. So that's why IFRS 8 excluded. And interim reporting, because interim reporting is also done by very big organization, the listed entities, very big in size, very complex, so many activities are there. Okay, SMEs usually don't have to do. SMEs can normally do in the normal reporting period. So IAS 33, IFRS 5, IFRS 8, and IAS 34, this 4 are omitted. Coming to the disallowed treatments, there are some treatments which are not allowed under SME standard but allowed under full IFRS. There are 3. Number 1, NCI cannot be measured at fair value under SME, but it was allowed under full IFRS. Full IFRS have the choice, either full fair value or proportionate of net asset. Second, revaluation model cannot be used for intangible assets, but under full IFRS, yes, you can. You have a choice, cost or revaluation. And third, cost model only for the investment property if the fair value cannot be determined reliably. But investment property, cost or fair value, you can take both. But here, Only you can take cost if you cannot determine the fair value for investment property. Okay. In case you are not able to remember so many things that disallowed, then I would suggest that at least know the standard. Once you know that standard in front of you, you will automatically remember the difference. For example, the second point, it is relating to intangible assets. So just remember IS 38. Okay, revaluation model IS 38, because it is disallowed. So automatically something which cannot be done. So you will automatically remember it like that. Okay, revaluation model not allowed. Then the third one is relating to investment property, IS 40. And the first one is non-controlling interest. So IFRS 3. Okay. Now we are going to the simplifications. That means things are made easier. Simplified under SMA. Okay. First, borrowing cost, which is your IS 23. Okay. Always expense to profit and loss. But under full IFRS, you have to capitalize the cost. But here there is no such issue. Nothing to worry. Everything is expensed. Depreciation and amortization, you don't have to review annually. But under full IFRS, you have to review annually. Expenditure on research and development, always expensed. But under full IFRS, under IS 38, development costs you can capitalize if six criteria are met, but research costs are expensed. Goodwill is amortized over its useful life. This is a major difference because under full IFRS standards, goodwills are not amortized. They are never amortized. Yes, they are impaired. You check for impairment review, but they are not amortized. Other intangible assets, yes, but goodwill, even though goodwill is an intangible asset, it is not amortized under full IFRS, but here it is. And if the useful life cannot be reliably estimated, then take 10 years or less. It should not exceed more than 10 years. This thing was not there under your full IFRS standards. Then any exchange differences, cumulative exchange differences. This is IS 21. Okay. They are not recycled to profit and loss on disposal of an overseas subsidiary. But under full IFRS, under IS 21, you can recycle. When you are selling that overseas subsidiary, whatever the profit or loss you have recognized under other comprehensive income, you can recycle to profit and loss, but not under SME. And simplified techniques are permitted when measuring a defined benefit obligation, IS 19. Because usually these techniques are complex, right? You don't need to know how they are calculating. You don't have to know uh, what is the complex techniques under full IFRS. It's not needed. Just know it's simplified techniques. That's it. So that's it for IFRS for SME. And the next we'll be covering analysis and interpretation. Very important because this question and the current issue, this two always comes in your section B of your SBR. And your two professional marks are also there in this analysis and interpretation. So under this analysis and interpretation, what we are going to cover are integrated reporting, then non-financial measure, other financial performance measure, earnings per share, all those things. Okay, so that's it. And thanks for watching and see you in the next video.